dear AFI members, Inclusive Fintech Showcase alumni, distinguished guests, ladies and gentlemen, good morning, good afternoon, good evening, wherever in the world I'm finding you at this time of the day. Welcome from the Luxembourg office and welcome to the 6th edition of the AFI Inclusive Fintech Showcase. This meeting will continue the original goal of the showcase to connect and support dialogue between policymakers and regulators in the AFI membership. And of course, we have entrepreneurs, innovators around the table who are implementing solutions at the grassroots. Now, this edition is different. It is by design, different to those that we have seen before. 5 editions in, we actually have chosen to pause, to reconnect, and most importantly, to listen. Rather than inviting new applicants, this year we have brought back our alumni from the previous 5 editions, the builders and the problem solvers who have illuminated the Inclusive Fintech Showcase over the years. To every alumnus who has come back to join us, thank you so much. Your return is clear evidence of the community we have built together since our first edition, held in Kigali, as you remember, at the 2019 Global Policy Forum. We want to hear from your solutions. We want to hear from you how they have grown, where they have been tested, and what you have learned about working alongside regulators to reach the people who need inclusive services the most. Well, now, the question is why this matters. Let me give you a sense of an answer to this question. Our very first showcase in 2019 was won by OCO, a young company offering crop insurance to smallholder farmers over a basic mobile phone. Today, OCO reports insuring more than 25,000 farmers across Mali and Uganda, many of them buying insurance for the first time in their lives. I am delighted that OCO's co-founder is with us again today. The journey has come full circle. There are many other such inspiring examples. iFarmer in Bangladesh and Pesesha in Kenya, both showcase alumni, also return as key speakers today, still building and still partnering with regulators to widen access for farmers and small businesses, respectively. Critically, our members are meeting such entrepreneurial innovation with policy innovation. Members, including Nigeria and Eswatini, have developed national fintech strategies which seek to create enabling environments for inclusive and responsible solutions to flourish. And in the Pacific, 7 central banks came together to build the world's first regional regulatory sandbox, a shared, safe space to test innovation across their region. The Reserve Bank of Fiji credit solutions tested in that sandbox with bringing 1,000 additional households into the financial system. This is just one example amongst many across the network of what it looks like when regulators engage with innovation proactively and work together in partnership. Now we are on a journey because this progress points actually to a deeper shift in our work. Across developing countries, account ownership has now reached 75%, up from 42% only in 2011, meaning that we have seen a lot of progress. Access, in other words, is no longer the central problem, though concerted efforts are still needed to reach last-mile communities and disadvantaged groups. We now need to look also at the effective usage and quality of financial services available. According to the Findex database, only 40% of adults in developing economies save formally today. Credit is still out of reach for most small businesses, and insurance penetration remains far too low. Nearly half of adults in developing countries say they could not raise emergency funds within 30 days. These gaps matter because they affect the ability of individuals, of families, and of communities to reach a state of financial health. When a family can absorb a shock without being pushed into poverty, when a small business can invest and grow, and where everyone, including disadvantaged groups and vulnerable individuals, can plan for the future with some confidence. The innovators and entrepreneurs who have participated in the showcase over the years and are here today are working toward exactly these challenges, building alternative credit scoring for entrepreneurs with no formal financial history, designing identity solutions that give displaced people a way back into the system, and creating products to enhance digital financial literacy. In recent policy dialogues within our network, we have explored what the central bank or the financial regulator of the future might look like. The successful central bank or financial regulator of the future will need, as we see it, to possess the right mindset, a willingness to adapt, a wider and more diverse base of skills, and a relationship with innovators built on genuine partnership rather than a traditional linear relationship between supervisor and supervised entity. That spirit is exactly what I hope animates your discussions today. Now, today's themes you will explore here come directly from our members through the AFI Network's technical working groups. How do we harness artificial intelligence responsibly, both to expand credit and to strengthen supervision? How do we protect consumers as digital and tokenized assets enter everyday financial life? And how do we make sure that the most disadvantaged consumers, including refugees and other forcibly displaced persons, are not left behind? These are the problems your innovations are already working to solve, and we need to look at how to scale promising solutions whilst remaining vigilant towards risks. Now, let me close by saying that today's program will be an interactive one, and I encourage all present to speak from experience, share candidly, and challenge each other. What we learn here will be captured and will help shape AFI's work and the policies of our member jurisdictions in the years ahead. With that, it is my true honor to formally open the 2026 AFI Inclusive Fintech Showcase. I wish you insightful and productive discussions. Thank you very much.
Wonderful. Thank you so much, Dr. Henning, for those wonderful words and for taking the time to record that message for us. It means a lot to have your presence and support, even from afar. Okay, so now is time for the group photo. If everyone could please turn on your cameras, and flash those nice toothy smiles. We'll take a group photo now.
Hi everyone. Time for a quick jaw exercise, and I just need you to smile and hold them for the next 10 seconds. All right, all good, Vidya.
Okay, awesome. Thank you, Amelia. All right, with that, let's move on to our first session for the day, which is on fintech trends, regulatory and industry perspectives. This session will feature 2 presentations, followed by an open Q&A discussion. So it is my pleasure to introduce our first presenter, Professor Olayinka David West. She's the Dean and Professor of Information Systems at Lagos Business School, and a familiar face to many of us as a former FinTech Showcase judge. Professor Olayinka, a very warm virtual welcome to you. The floor is yours.
Thank you, and hello everyone, and welcome back to the AFI platform for the Inclusive Fintech Showcase again. Well, my job here is simple. Let's go to the next slide, please. I'm really here to share with you regulatory and industry trends as we've seen them over the years. And I think as those of you who are in the industry know, there are things that are converging and in some cases diverging. But I think as we go through the conversation today, one thing I want to say is that on the regulatory side, we can see that on the regulatory and industry side, there's a convergence in ambition, right? But I think where we're diverging is in practice. And the bottom line is, how do we close the gap and what mechanisms do we use to close the gap? And that's where the story lies. So I'll proceed. Next slide, please. Dr. Hannig has already mentioned some of these, but I'll just emphasize on some of them. When we look at the global landscape and try and set the page for the big picture, I think one of the daunting things is while we've made progress in digital financial services and inclusive finance, according to the World Bank and Global Findex, there's still about 1.4 billion people who are still unbanked. And sadly, 57% of them are in sub-Saharan Africa, albeit that sub-Saharan Africa with M-Pesa was the one that sort of started to grow the market about digital financial services using mobile money. And also the fact that we still have more than 800 plus fintechs operating on the continent. We boast to have the largest amount of unicorns, especially the ones coming out of Nigeria. So this trend sort of raises a lot of eyebrows. But then again, all is not lost because if we go to examples around Brazil, and what they did with PICs during COVID, you would see that the numbers have really, really grown when you think about it. PICs currently has, I think, 140 million. They registered 140 million people in the last couple of years, in 3 years, and then they also have grown in terms of transaction volumes. And then we go to India as well, where we see the growth in the UPI and the single volume of transactions. I think in 1 month, they recorded about 12 billion transactions. So when we look at what is going on, we can see that there are ways and means and mechanisms in that the tools exist, the models are proven, but the question I want to put to the room is whether the emergency momentum of COVID, when regulators moved fast, relaxed, and with KYC approved digital licenses overnight, has that produced a durable structural change? Or are we simply building more sophisticated looking versions of the same exclusionary system? And those are the things that we need to think about as we carry the conversation forward. Next slide, please. So let's look at some of the industry perspectives. And because of the large number of excluded within sub-Saharan Africa, I'll also sort of globally look at it, but also point out to issues in sub-Saharan Africa. When we look at the industry, you see that, like I mentioned earlier on, there's 800 plus fintechs. And what another thing that we've seen in terms of venture capital funding, a lot of them have raised capital. And then also we've seen a growth in mobile money accounts and also faster growth in global averages. So we see that Africa is moving forward by any measure. And then the four business models in the center will tell you how. We see the super apps removing the need for a bank account entirely. We see agent networks putting financial services at the last mile within walking distance. We see alternative credit making a billion, providing access to credit and ensuring that customers are visible for the first time. And we also see the growth in B2B infrastructure, which are building the pipes to make all this possible. But now, when we ask ourselves a true and honest question, I think the real question is who is really being served? The fastest growing segments, buy now, pay later, crypto, and neobanks primarily serve urban and middle income smartphone owning customers. The unbanked are the mission statement, but yet they're not always on the product roadmap. 912 billion moved through mobile money in 2023, but most of that is P2P transfers and airtime. Like Dr. Hannig mentioned, savings, credit, and insurance, the tools that actually build financial resilience, remain deeply underpenetrated. And since the 2022 funding crunch, several fintechs have quietly pivoted upmarket, abandoning low-income segments where they were founded to serve. And the infrastructure is still maturing, but scale of activity and depth of inclusion are not the same metric. And the market alone will not close the gap. So we need to look at those in terms of the dichotomies that we're building as we go for venture capital funding that is ultimately going to seek profitability. Next slide, please. So when we look at the regulatory landscape, we've sort of categorized this into three stages in terms of the regulatory trends. We have enablers, we have mixed reaction, and contested. And what are those enablers? Open banking. I think the open banking regulations that we're seeing, both in Nigeria, the EU PSD2, and in Australia, have really broken the dichotomy or the conundrum between legacy banks that have the data and new entrant fintechs that really just have the technology. And that's sort of bridging the gap. And it unlocks data access for new entrants, but implementation costs exclude the smaller players. We've also seen we've rated the tiered KYC mixed because again, while we want the tiered KYC, we also need to be mindful of regulations like FATF, and we've seen some African countries recently come off the grey list. And so what we're looking at there is how do we continue to be mindful of the proportionality while also being ensuring that we're doing the right things in terms of onboarding the customers. The next area is digital ID, and this is transformative when the infrastructure exists. India's Aadhaar reached 1.3 billion people and became the backbone of digital payments revolution. Ghana card is also promising, but Kenya's Huduma number ran into constitutional challenges over privacy. And the big lesson is digital ID is an enabler, it's not a given. And the civic registry gaps in fragile state means that the tools can reach the most excluded. I think the last one that is also being contested is the crypto, whether it's through the CBDCs or stable coins. But I think, again, we need to think about that. And those regulations are still evolving and are being contested depending on the legacies around Bitcoin and other unregulated cryptocurrencies. Next slide, please. So in conclusion, I think the two things that we need to look at here, where are the opportunities? And we believe that opportunities lie abound. Embedded finance is one of the opportunities, and I'm hoping that some of the speakers will speak to some of the things they're doing in that area. AI credit scoring, where we think about alternative data sources and opening up access to credit, which is one of the underserved areas. We also see in Africa this issue about interoperability, and we have the Pan-African payment rails that are trying to, first of all, cut out USD intermediation because technically, to send money between African countries, we have to go to a third market and a third currency, which is USD. So how do we make things faster? We have tips that's working within the Southern African region and things that are happening in that area as well to ensure that payments and financial flows can move around. And then also we have opportunities in CBDCs, stable coins for transfers. I think Nigeria's CBDC, even though it did not quite gain the traction, still managed to get about 13 million wallets, both consumer and merchant wallets. I think on the risk side, we also need to highlight some of these risks as we're talking about AI and as we're using AI for credit scoring and alternative data processing. We also need to be mindful that there's algorithmic bias. How do we ensure that we have the right governance frameworks and AI governance frameworks in place? We also need to be mindful that making credit accessible could also create digital debt traps. How do we ensure that we manage those two? On the increase is also the issue of cybersecurity and fraud. How do we continue to keep consumers safe? How do we continue to ensure that the platforms that we're creating and the access we're providing is also used responsibly? And finally, we have the platform concentration. How do we ensure that we're not creating monopolies in the same process? So, ladies and gentlemen, in conclusion, my last slide is now the questions I want us to think about are really one is the regulatory capacity. And again, how do we encourage or how do we help regulators that regulatory frameworks as they're converging in form but diverging in capacity? How do we bridge the gap between rulemaking and rule enforcement in markets where supervisors are under-resourced? And that's an environmental and a hygiene kind of question that we need to think about. On the other side, my final question or thought-provoking question to open up with is in the area of market structure and concentration. How do we ensure that we're not creating monopolies? Is interoperable concentration the right model, or are we building tomorrow's monopoly problem today? So let me close with this observation, ladies and gentlemen, that financial inclusion is ultimately a political choice that is dressed in technical clothing. Regulation follows power, and in fintech, power is shifting fast. The question is whether it is shifting toward the people who have historically been left out or simply toward a new set of intermediaries. So I look forward to our conversation going forward. Thank you for listening. Thank you.
Wonderful. Thank you so much, Professor Olayinka. Yes, do keep the clapping going. That was a truly insightful presentation, and the questions you posed, I think, are definitely a great way to open our discussions for today. But before that, let's move on to our second presenter for this session. I'm very much delighted to welcome someone who holds a very special place in AFI's Fintech Showcase history, Simon Schwal. He's the co-founder and director of Oko Finance and the very first winner of AFI's Inclusive Fintech Showcase back in 2019. Simon, it's a pleasure to have you back with us. The floor is yours.
Thank you very much. I'm very happy to be part of this event as well. So as a reminder, I'm the CEO and co-founder of Oko Finance. And what we do at Oko Finance is we build parametric crop insurance for smallholder farmers across sub-Saharan Africa. It is sold and paid out entirely through mobile phones, triggered automatically by satellite weather data. Some of you might remember us from 2019, where we indeed won the very first AFI or AFI Fintech Showcase in Kigali. And this recognition coming from regulators told us that this model could effectively work. 7 years later, I want to use my time honestly, what's working, what regulation has helped, and where it's actively getting in the way, and what I think we should do about it. So let's move to the next slide. Next slide again, sorry. So this is the model in one sentence. We sell parametric crop insurance. The premium is collected by mobile money, and the payout is triggered automatically by depending on satellite data, weather data. There is no claim form, no loss adjuster working the fields, so it provides a lot of transparency, and it's a lot more cost efficient than traditional insurance, which makes it in turn more accessible to smallholder farmers. We monitor weather events remotely. In a normal season, when nothing happens, that's the green arrow here, we don't need to intervene. But if our satellites detect insufficient rain, for example, or drought, then that's an adverse weather event, and the system validates it automatically against the data. The payout lands on the farmer's phone, often within days after the season ended. Today, that's more than 33,000 farmers that have been insured across our markets, Mali, Ivory Coast, and Uganda. 500 of them, more or less, received the payout, and we paid out total $375,000 to farmers. No paperwork, no waiting. So that's not charity helping farmers in need. That's really risk management made easy and accessible. Next slide. So I was asked to talk about fintech trends, what I've seen from my seat, from my position as the CEO of an insurtech company. And I chose to talk about these four trends or topics here. First, mobile money. So mobile money is really not a trend, but really an infrastructure today. We use Orange Money in Mali, MTN Mobile Money in Ivory Coast, and Airtel in Uganda. We use Wave as well. And these are really the payment rails that make everything possible. Without them, collecting $3, a $3 premium from a farmer in a remote village is logistically impossible. Second is digitization, and in our case, Earth observation. So the transactions being digitized, data being made available online, this all helps us design new products. So yeah, digitalized payments and customer records, all of this is helping us. It's providing us the data that is good enough to trust with real money. There is still some ways to go. For example, weather forecasts or weather institutions in each country are lagging behind in terms of digitization, and we cannot work with them often, and we need to work with global players. But still, it's going in the right direction. Embedded finance, and that's a topic that was already mentioned before. So bundling insurance into a loan at the moment of when the farmer borrows for seeds or for inputs is the highest leverage distribution model anyone has found so far. That's the moment when farmers are the most receptive to protect their investment, their endeavors, and that's also when it's easiest for us to collect the payments. So we developed APIs that can be added to the onboarding process of farmers, and that's really where we see the most growth being possible. Finally, AI and automation. So these are accelerating claims and building trust faster. And trust is a huge part of what regulators are trying to build, and what is currently lacking, especially in the field of insurance, where lack of transparency and delays in payments have damaged the relationships often between the population and insurers. So I think this is also a very key trend to follow. We can serve a lot of smaller customers in higher numbers thanks to automation and AI. So really, from this slide, I would say the constraint isn't technology anymore, and the remaining barriers are more in the mundane things like customer education, but also regulation and partnerships. So that's where I'm going to go in the next slides. So regulatory environment, what helped and what's on the way. On licensing, regulators across Africa got the big call right, I would say. Most insurance laws recognize parametric and index-based insurance as legitimate products. I think only South Africa is still on the edge. So that's that single decision made it possible for Co to launch in multiple markets. So if some of you are responsible for that, I'd like to thank them here. But then in some other markets, actually in the CIMA region, for example, the regulators say that even if you hold a full-fledged insurance license, you need a separate micro-insurance license to sell our products. And why? If you trust an insurer enough to give them a full license, why does selling smaller policies with lower money involved require a second permission slip? That's not really consumer protection. That's just building a queue and a new pay gate. Second, on distribution. So simplifying group insurance and opening it to new entities like post offices or MFIs has helped enormously. And mobile money interoperability, now lets us collect premiums and pay claims seamlessly. That's very helpful. But then there's a contradiction. We registered, in our case, we registered as an insurance agent in the 3 markets I listed. And this only added paperwork, not really benefits. So I think it would be great if licensed distributors could be somehow helped or benefit from other services, because today most of our competitors just offer crop insurance through group policies, and it's good that it exists, but it makes us question why even go into the trouble of registering as an insurance agent. Also, the commission cap on distributors is an issue. These commissions have been set for selling insurance to someone in the city, but try explaining a parametric drought policy in a language with no word for index, or even no word for insurance, to a farmer with low financial literacy. With the same commission, it just doesn't work when we have, for example, in Uganda, only 10% commission for distributing insurance. And that's where all the challenge lies, where all the work is being done. It's really not working. So I think there's work to do on that as well. Finally, there are incentives, and sometimes it can get almost absurd. In Mali, insurance is taxed at 20%, while VAT is 18%. So it means that we tax protection against climate shocks more than we tax everything else, like a can of Coca-Cola, for example. That doesn't make sense to me, and I hope it doesn't make sense to you as well. In Uganda and in Senegal, we've seen that initiatives where product design is centralized by a consortium, for example, the Agro Insurance Consortium in Uganda, which comes from a good intention to make products more easily accessible to insurers. But it all at the same time kills the competition and innovation that is really needed in this field. So here it's a double-edged sword, I would say. And in Rwanda, another statement I would say is, yeah, there is a scheme, but insurers can only apply for it in rare occasions and during short windows, and doesn't make it very easy for insurers to offer crop insurance. So these incentives are sometimes not working in the benefit of farmers or insurers. And I think what I would promote more is defiscalization, like reducing taxes or removing taxes on microinsurance products, which in my opinion would be much more helpful. Finally, let's move to partnerships. Yeah. So none of these can work alone, and innovators like us need to partner with legacy companies and with government companies, government institutions to make things work. In our case, we partner with the insurance sector. We partner with Sanlam Allianz to underwrite most of our products, Allianz Re to provide the reinsurance capacity behind it. And while we could apply for a microinsurance license, it really was more straightforward to build partnerships than to take the risk of applying for a license. And I think, yeah, it should also be encouraged by regulators. MFIs, and yeah, I'll try to wrap up quickly. Just quickly on MFIs, because that's the key to distribution. That's the most impactful channel for distribution. But the problem is that MFIs cannot charge as much as they want in admin fees, and it's understandable, but it means that often they cannot afford to add the insurance premium in the admin fees or in the cost of the loan. So that has been blocking us in many places. The other thing with MFIs and banks is that they don't really compete for the farmers. Like they compete for urban populations, but a lot of the loans are not. There's a big lack of loans given out to agricultural projects and farmers. In Uganda, I think there has been a lot of pressure on banks to give more loans to farmers, and this helped to also increase the penetration of insurance. Let's move to the last slide. I think I'm going to try to wrap up on my suggestions. So 4 concrete changes. 1, proportional licensing. That's what I said about full insurance license versus microinsurance license. 2, replace incentives by just better fiscality, lower taxes on insurance. 3, commission reform for rural distribution. So allow for more commissions for distributors that make the effort to distribute in rural areas and or more generally the microinsurance products. And 4, I say here, carve out insurance bundled with loans. But more largely, I would say, I think it would be great if, as regulators, you could enforce that that more loans are given to agricultural projects, to the agricultural value chains, and it will mean more risks for the banks. So they will need de-risking tools like ours. They will need the farmers to be equipped with insurance. So that's going to naturally increase insurance penetration. That's where I will end. I hope that's helpful to have the point of view of an insurtech, and I would be happy to answer your questions.
Thank you so much, Simon, for yet another fantastic presentation. We'll now move on into the Q&A discussion for this session. So we'll bring back both our speakers. And also, it is my pleasure to introduce the moderator for the session, for the Q&A discussion, which is Miss Sarah Corley. She's the CEO of the Alliance of Digital Finance and Fintech Associations, and she's a valued strategic partner of last year's AFI Inclusive Fintech Showcase. So please do ask your questions. And Sarah, the floor is all yours.
Wonderful. Thank you so much, Vidya. Thank you as well to AFI for allowing me to be part of this today's discussion and last year's showcase. And to Olayinka and Simon, what great presentations. It really hit home listening to you both, how infrastructure technology, regulation, business models, and partnerships, are all kind of bundled together, and they all need to work for us to be able to move that needle in financial inclusion. So I'm going to start by encouraging our participants. Please do post your questions in the chat. I have a few that I would like to ask, but of course I would rather ask yours as well as you're participating in today's session. But I can see that we've had a really interesting question come in from Karam, from the State Bank of Pakistan, I believe. So Karam's question was, farmers are often unbanked and most definitely in most places underserved. How can regulators help bring them into the fold and encourage them to use digital financial service products, whilst at the same time ensuring they're not taking advantage of because of their limited financial or digital literacy? Simon, that question was posed to you, so let me put it to you first, and Ole Ginker, I'm sure you'll have some comments to add.
Okay, thank you. So I think it's a very good point, and surprisingly, small farmers, for example, they do use financial services, just not necessarily the formal ones. When we talk to cocoa farmers in Ivory Coast, they do borrow money, but usually not from banks or MFIs, but it's from trackers, like from pisteurs, they call in French. And so people who collect cocoa for the different farmers. So people who are not financial experts, but they are present, they are there, and they are trusted. There's a real trust relationship between farmers and them. Same thing for remittance. We see in Mali that a lot of people use an informal remittance system where people give each other money in France, let's say, and the exchange is then done in the country. So even though they're not financially literate, they have the needs, they have the usage already. So I think what's needed is education and maybe making services more accessible, more approachable. We see that farmers are often intimidated by formal institutions. So I don't know, it's too short of a time to give a full solution, but one thing that I could think of is having a one-stop shop, for example, in rural areas, where someone can come and ask questions about, very candidly, questions about finance, and maybe where a range of solutions that have been reviewed, that have been tested maybe by the regulator, that have been approved, are presented so that they know what, there's kind of a label that can increase trust between the farmers and institutions that, are not necessarily well known, or there's no trust yet being created. So education and maybe some kind of labeling or vouching from the regulator for services that have been proven to be helpful.
Thank you so much, Simon. Ole Ginker, anything to add?
Yes, I would take a different approach and ask for product developers to build products that are inclusive by design. And what I mean by that is, we know the farmers' traits and characteristics, right? We know they're not very well educated, or they don't have at least formal education, and they're not very well they're not literate in our traditional English and or whatever language that we use. So I think that we can't wait for them to do all the work in terms of meeting the tools where they are. I think the tools have to sort of backward integrate or reverse engineer to meet the farmers where they are, to ensure that, first of all, they put in the right safeguards. We know the users don't have the breadth of knowledge and access around fraud and scams and things. So how do we ensure that we're putting in the right safeguards and warning systems to ensure that they're not manipulated or they're not treated vulnerably? Now, this actually makes the design process or the development process more difficult for the builders. So we want to pass on that work. But I think that adoption and trust will grow if we bring it into the tools and into the system and ensure that they feel that this is built for us, not we have to upskill ourselves to get to here. And as you do that, they would begin to learn more and they'll begin to grow more, and usage will also become a bit stickier. Thank you.
Thank you. I mean, it's a good reminder that there are multiple different ways in which we can try and tackle this problem, both from the industry perspective, what can be done, but also looking at it from a regulatory perspective. And I would imagine, both of those things need to be done, almost together to really sort of, make that and move that needle. And we've got another question that's come in from Hammer. This one again is directed at you, Simon. You mentioned Senegal and parametric crop insurance. Could you elaborate on that point?
Okay. So in Senegal, there is something called CNAS, the Compagnie Nationale d'Assurance Agricole du Sénégal, I think. And I'll explain to Uganda because it's a bit similar with AIC, the Agro Insurance Consortium. These are entities that have been created as either a governmental sub-entity or a consortium of insurers. And they asked experts to design some crop insurance products that then all insurance companies can distribute. So in principle, it's great. You don't have to replicate the work in each insurance company and to have different products. It accelerates the availability of these products. But then what happens is that, for example, we also can design products, but if we come with our products, they will not be accepted by everyone. They will not be subsidized because they're not part of this pool of products. And the products that exist, sometimes they have been disappointing to some farmers. Sometimes they don't really fit the need. And when we talk to insurers, I say, yeah, but we don't want to compete with, we don't want to create another product that is going to compete with this consortium where we're already involved. So I think while the intention was good, maybe the role of this consortium could also be to approve other products so that they can also be added to the list of products that are available to all insurance companies, or be also eligible for subsidies, instead of blocking the products and therefore blocking innovation and competition, which is helpful to in a young environment to improve the quality and the price of the products.
Thanks, Simon. You mentioned something really interesting in that last sentence, sort of, which I think, Yinka, you also touched on, about this monopoly, about we want to create really good competition in market, because that can often drive lower prices, innovations. Yinka, what do you feel from a regulatory perspective could really drive that competition in markets?
I think it's being aware of how we want to get to the end goal and we want to get there quickly, right? And that's why I said we have the same ambitions. So it's really now, what practices do we put in place to ensure that in reaching those ambitions, we're not also killing the market? And competitiveness is one of the areas. So what we need to look at is, again, like I think Nigeria tried to do this with the Payment Service Bank in licensing framework, where we said, okay, you're not really going to operate as microfinance banks. You're not going to operate as traditional banks. So in terms of the activities that you're permitted to do, there's limited activities. There's also location-based frameworks, and your business model, you must be located in certain rural areas and things. So that creates that spreading of the market rather than trying to create that concentration. So it's really about understanding the goals, understanding the needs. But again, being mindful of economic pressures, right? And I think that's really the chicken and egg situation. And when they ask people to go and operate in low income areas, there's also, how do we build the business models and the economic activity that will support that? And again, at a critical mass, because it's not just about, especially rural areas that are widely dispersed. So I think a lot more modeling needs to be done and thinking around, again, what regulations do we want to put in place for players acting in this area, meeting a goal, but then again, might not have the financial rewards and benefits. So it's that incentive management that we need to think about as well. Thank you.
And Simon, I'm just going to quickly ask you for a response on that, because from my position, one of the things I hear very much in line with what Yinka just said is that fintechs have a small margin of profitability and need to be profitable entities and scalable entities. What are some of the sort of key challenges that you might like some of the regulators listening to focus on to support that for all fintechs, not just Oka?
Yeah. So as I said, I think the barriers are not always, not so much technological or even regulatory, but often it's education. And for example, in our case, we have to spend a lot of money and time to educate the population, to advertise about what is insurance before it can be trusted and used, which is not usually the role of a bank or an insurance to educate consumers. There's a bit of education that is needed, but here, in our case, that's a lot has to be done. So I think if there could be programs that, one thing is the programs to educate the population, to which maybe fintechs could plug in, meaning at the end of, for example, a rural session about different financial services, there could be different companies that have been selected who can present their solutions. The other thing is to test new things, we often need funding. So here I didn't have time to talk about it, but the development funds, the bilateral cooperation between countries, extra, often bring, or the grants can bring very welcome funding to test things that private investors are not so willing to test because it's not proven yet. But the other side of this is regulatory, meaning if we could have a sandbox, like an allowance to offer a product at a small scale under the supervision of the regulator without the formal license, just to test an idea, a concept, then we would have the funding and the regulatory approval and support, and we could test things quicker, and it would help come to profitability quite quicker. An example for that is in Congo, Republic of the Congo. We asked, we sent a request of a letter of non-objection from the regulator, but they say, no, you cannot ask for it yourself. It's the insurance company who needs to do it, and they need to bring it on site to our office. So all of this made it almost impossible for us to obtain this letter. So if there was a sandbox that we could request digitally by email, then, I don't know, that would definitely help us.
Wonderful. Well, thank you so much, Simon and Olayinka. Sadly, our Q&A time is up. In fact, we've taken a few extra minutes. So we need to stop now and allow for presentation number 2. But thank you very much. And if anyone still has any questions, please pop them in the chat, because I'm sure Olayinka and Simon will be happy to ask them. Thank you so much.
Thank you.
Thank you.
Thank you so much, Professor Olayinka, Sarah, and Simon. That was such a rich and engaging discussion to kick us off. We now transition to session 2, Innovation and Regulation in Practice. This one is a little different. There's no slides, there's no presentations, just an open, dynamic conversation between 3 former FinTech Showcase alumni sharing their experiences at the intersection of innovation and regulation. Here to steer that conversation is AFI's own policy expert in competition and financial inclusion, Ms. Anthea Pailo. Anthea, over to you.
Thank you so much, Vidya, and good morning, good afternoon, good evening to everyone here. I've been enjoying the discussion so far, and I'm very excited to hear what the other panelists have to share with us. And here to take us through the panel are a very exciting group of people, entrepreneurs and fintech specialists, if I may call them that. And I'll be very happy to introduce them to you. In no particular order, I would like to introduce to you Eric Kariuki, who's the Chief Compliance Officer of Pesesha. He also has an extensive experience in fintechs and startups. His practice focuses on helping innovative businesses navigate complex legal and regulatory environments. Eric also has developed practical insights into the challenges and opportunities that arise at the intersection of innovation and regulation, and is here to give us a little more experience from Pesesha and share with us what they've been learning. Maybe just a silent applause for Eric as he joins the panel. I'm also very happy to introduce Parvinjit Kaur, who is the CEO of Binor. She's a fintech strategist, ecosystem builder, and a serial impact entrepreneur who has built and led financial ventures across 10 countries in Southeast Asia, the Middle East, including India. By 24, she had founded a Savin Fashion Studio, a macro factory in Malaysia that provided dignified employment to refugees, domestic employment survivors, and persons with disabilities. She's here to share with us the amazing story of Binor Capital. A warm welcome to Parvinjit. I'm also very happy to introduce to you Fahad Ifaz, who is the CEO and co-founder of iPharma. He's an entrepreneur and ecosystem builder driven by the vision to create innovative, sustainable, and resilient solutions for poor people in emerging economies. He's the founder and CEO of iPharma, where he works for the intersection of agriculture, technology, and financial inclusion. He strongly believes that entrepreneurs are amongst the most powerful catalysts for human development. Prior to iPharma, he spent over a decade in market systems development. A warm welcome to my panelists and some applause for them as they join the panel. And as we start, I'd just like to warm us up a little bit. I'm going to ask each of the panelists to just briefly share with us a little bit about their particular fintechs, just to get the audience understanding a bit of what their fintech does, what the institution does, and really what brought them here. Just briefly, in maybe 30 seconds, a bit, just to give us the audience a bit of understanding about who you are. I'll go in order of the introductions: Eric, Parvinjit, and then Fahad.
Thank you, Anthea. So I work with an entity called Pezesha Africa Limited. We are a fintech out of Nairobi, and we have offices also in Uganda. Our main focus is enabling the underserved SMEs to access working capital. We've been able to achieve that through working with and undertaking what is an embedded finance model, which is partnering with larger partners to be able to access SMEs that work with those partners. In Kenya, we've worked with a partner like Safaricom to access merchants and provide them with working capital. We also have an innovative product that allows us to assess and understand the customers, an internally developed credit scoring algorithm that helps us to best score and understand the risk bucket of each of customers. So I'm happy to be in this session.
Thank you, Eric. Over to you, Parvinjit.
Yes, hello everyone. My name is Parvin from Malaysia. Firstly, thank you, Anthea, for the warm introduction. I'm glad to be here to share my experience over the years in building fintech products and along with mainly on the productive inclusion. And this has been the main work that I've been working on over the past few years under Binor Foundation and also Binor Capital. Having worked across for 17 years, I realized that capital alone is not enough on how do we actually improve the livelihood of MSMEs and mainly focus on MSMEs and how do we actually embed capability along with it so they can grow sustainably without any handouts. And the concept that you're working is mainly on the Islamic finance about micro private equity and how we can co-invest with them and not only for the monetary gain, and also to channel the capital, but mainly how do we provide the capability that is required in terms of the knowledge, because human capital is one of the constraints as well for MSME to grow and how we can actually move them out from survival, at least to the stable stage. Yes. Thank you.
Hi everyone. So my name is Fahad. I'm the co-founder and CEO of iPharma. iPharma, we're based out of Bangladesh, and we are, for the farmers, we are a one-stop solution. So farmers get access to finance, access to inputs, advisory, and access to market. Till date, we have worked, or our network is of about 320,000 plus farmers. Then again, Bangladesh is a country with 20 million farmers, so we have just started, and we have facilitated more than $100 million in financing for these farmers with a repayment of almost 98%, right? And then on top of that, we also operate a e-commerce for agri-input distribution, where the retailers are now brought into a formal marketplace where they can order agriculture inputs, climate smart inputs, and machineries as well. Right now, we're trying to expand our financial service only for farmers to retailers as well. Because these retailers, they are sort of SMEs who needs working capital to get access to inputs. So yeah, thank you so much, and glad to be here.
Thank you so much. I'll encourage the audience to please share any questions now that you've had a little bit about what our panelists do. But just to start us off, we're discussing about innovation and regulation, and you all have amazing products that you're bringing into the market. But we know about how sometimes traditional regulators struggle when there's a new product in the market. They don't understand how it works. How have the regulatory requirements that you've experienced shaped your product development, your strategy for entering the market, and how you've scaled up over time? I'm going to start with Fahad this time. Just try to let us know about the regulatory requirements you've experienced and how they've shaped your journey.
Yeah, so when we started iFarmer, the first idea was getting access to finance for the farmers. Now, of course, we reached out to the major banks in the country. Unfortunately, got rejected by all of them. But then we had to come up with a model where we could get access to these financing and then make sure that the farmers get access to those financing through us. So we started a crowd investment platform in Bangladesh. And mind you that back then, Bangladesh did not have such platforms, so no policy, nothing whatsoever. So we went to the central bank. This was back in 2019, gave a presentation that, well, this is what we want to do, but we don't know what kind of license or, what do we really need? I mean, we want to do something, but we're not just sure what to do with it. And we were just starting, right? So the central bank, the first thing was they listened to us, but then of course they did not have anything to offer because we're not a microfinance, we're not like a bank, NBFI, and we're too small to even apply for those licenses. But I think they allowed us. They gave us some verbal guidelines, right? That, okay, fine, this is what you can do, this is what you can't do, but at the same time, we can't give you anything in written because we don't have anything, right, to offer to you. So yeah, I think over those years, this is our 6th, 7th year. We're finally at a stage where, the central bank is, working on a crowdfunding licensing for Bangladesh. But during this time, I think the central bank also in a way helped us to work with banks, the same banks who rejected us. I think central bank directly, indirectly sort of, worked or helped us in getting in touch with these banks, allowing us to have conversation with these banks. The banks looked at our model, and right now we work with top 5 banks, in the country, through whom we're, channeling financing to the farmers. So the good thing about this is that the central bank never came and stopped us, from operating. They looked at, but of course they had an oversight. I think I forgot the number of times I had to visit central bank to answer questions, meet different committees, and give these pitches like, what are we actually trying to build here? So yeah, but at the same time, I think it's also a challenge, right? When we're trying to raise equity funding, we're going to VCs, we're pitching to investors, but then they're like, guys, do you have any policy from the central bank, because otherwise, it's a risk for any investors, right? And so I think it plays both ways. I mean, they helped us, but at the same time, we had to navigate through these difficult waters, I'd say. But right now, I think there's more conversation happening overall in terms of fintech and how we can have fintechs without the dependency of a bank. I think that was another thing that I've seen regulators where, I mean, like Bangladesh has one of the largest MFS company in the world, right? bKash. But when bKash started, they had to be backed by a bank, right? A major bank. So I think this dependency with banks, that if you have to be a fintech, you have to have backing, ownership, something of a bank, versus you can be a fully operational entity without a formal stake of a bank. I mean, you can always have partnership with banks. I think that mindset is changing, which is a very positive thing. Even though we work with banks, but again, banks have their own way of doing things. I think in the previous conversation, there were some conversation about this, how banks are not really able to reach, because that's not how they're built, right? I'll give you a very interesting context. Farmers, when we offer financing to these farmers, honestly, they don't care about whether it's a subsidized loan or a commercial loan from a bank, because his or her next best alternative is an informal trader who's pre-financing him at almost 40%, right? So if you go and tell them, well, commercial rate is 12%, there are subsidized rates from the central bank, 4%. They're like, I don't care, but what I care about is, when am I getting the money, right? The timeliness of disbursement is something that currently we are trying to navigate with our partner banks as well as central bank through digital origination, disbursement and all this stuff. So I think that's where we still have to work on. But so far, as I said, we did not get immediate support when we started iFarmer, because there's nothing there to offer to us. But at the same time, the central bank never came and said, well, you can't operate just because you don't have a license, right? There's a sandbox under which we operated, and we have been operating for so long. So yeah, thanks.
Okay. No, thank you, Fahad. You've raised a couple of interesting points there. One about really the uncertainty in the space, but also the flexibility that the regulator allowed you, even when there was no regulation, no clear understanding, but also about the gap that you're feeling in between the banks and the fintechs are feeling where the banks cannot actually reach. You're performing such an important role there, but also how sometimes the regulator is comfortable working with a partner that they know, which is a bank, and so there comes a partnership issue there. So thanks for raising those important points. Parveen, let's turn to you and just understand what kind of regulatory requirements you've experienced, how that has shaped your journey.
Okay. So for me, based on my experience operating digital fintech across multiple 8 countries, especially in Southeast Asia, somehow regulation shaped our business models before even the product is even built. Because it is not only about the licensing and the compliance after the product is launched. It affects actually where we set up, even for our operations, even our regional office, which market we enter first, which partner we work with, how we design the product, the transparency of the pricing, and how far we can actually scale responsibly. So what I would say also that the same product that we might have, it looks very general. Okay, I think we can copy paste into another country. Oftentimes that's not the case, because every the same product need to be adapted according to the regulations, with the right risk control, customer journey, and also the disclosure and the speed of expansion also need to be adapted to the regulatory environment. Because ultimately, I always believe that, the intention of the regulator is because they have the public mandate of ensuring that any products that is being launched, it is serving and is safe, and we are not exploiting in the name of serving the underserved. So that has always been the anchor, and that also been our right intention, is that is our product really solving the problem? And if it aligns with, okay, we are serving the underserved market to the best of our intention using certain capital products and things like this. And that means we also always engage with the regulators as well. Because example, when we set up in Vietnam, there was not really regulations in place, but instead of thinking of uncertainty or just like operate until we get these love letters from the regulators, but also continuously engagement. Okay, this is the product we are starting. This is the idea behind this. What is our intention? Which are the customers we would like to focus on? How the costing going to work? And we would like to seek there is any feedback you would like to provide, because there is no clear regulation. Because oftentimes when we started like 10, 15 years ago, there was a lot of gray areas. And so this is, yes, coming back to what I said earlier, it's always been the first thing, even in our product design. How can we actually not deter the regulations from, stopping us to innovate, but how we can actually think creatively and work alongside the regulator.
Thank you, Parveen. I find that quite fascinating and an interesting insight. That even the regulation, which market you enter, whether it's conducive for you to enter, is also determined by the regulatory framework. So what you see, how you behave, the partners you will have is really determined by the regulatory framework. And I find that very, very interesting. Eric, I'm going to turn to you before we go to the question in the Q&A. But yes, I'm also interested in your own experience. Mobile money is a big thing in East Africa, and I'm sure it has determined a lot of how your work is shaped. But how have the regulatory frameworks changed for you? How have they shaped how you entered into the market and how you're scaling up?
Thank you. So I'd say I can draw my experience from both presenters that have come before me, mainly because there are a lot of similarities with what we've experienced. So first of all, when we started the business in Nairobi, there wasn't per se a regulatory framework that could govern. So what we did is we sought to partner with the Capital Markets Authority here in Kenya under a sandbox testing program that they introduced, which we went through, and that gave us some level of validity, and we were able to now comfortably go to the market based on that, because we had a couple of entities in our market, in our sector, being closed down because of the lack of regulatory oversight that was actually over them. Later on, CBK then introduced regulations for players in our sector. We went ahead to be regulated and licensed by the CBK. One of the challenges we found there was it takes a bit of time. I agree with what others.
Mais dois tais.
Sorry, may I ask that we all be mute? Thank you.
Yeah, I agree with what Fahad's sentiments about the delay, the duration it takes for some of the regulators to get ahead. So it took a bit of time for us to be given a license here in Kenya. It took us about almost a year from when we applied to when we were issued with the license. So it was a bit of time, a lot of sessions with them, a lot of Q&A questions. Then eventually we were able to get the license. When we were moving into Uganda, so in Kenya, we had the experience of just one regulator regulating us. In Uganda, we realized that you first of all have to be issued with a money lending license. Then secondly, you have to be issued with as an operator of an e-commerce or an online platform. You have to be registered as a tech operator. So those multiple licenses that you have to go through, and the many hoops you have to jump are a challenge. But once those are overcome, it's working with the regulators has been easy. Then on, I think the other challenge obviously is some of the regulators, like in Kenya, Central Bank requires us to seek approval of pricing and it takes a bit of time for them to come back to us once you put in the application. So that means that there's a level of lag, and it affects our ability to move to market because you have then to wait for the regulator to come back to us.
Thank you. That sounds very, very, very familiar. And even linking back to the previous presentation where we talked about this multiple levels of or duplicated, what we'd call duplicated regulation, all these different hurdles that you have to do to get licensed. That's very relevant. I'm just going to go to the question in the chat here to Fahad in the meantime. So the question is, crowdfunding is a very interesting concept, but regulators usually have AML and CFT concerns. So what did you do and what steps did you take to mitigate those concerns?
To start with, I think we started with full KYC of both on the investor side and the farmer side. Some of these farmer KYCs are so much in details that sometimes even the banks don't have these kind of informations, right? We go all the way to the farm level, right? Not just the farmer, but where the farm is as well, the location of the farm as well. And all of these data are visible anytime if the regulator, sometimes the banks want to see these as well. The second thing is that all money movement happens through designated bank. So there are no cash transactions. So from day one, we don't do any cash transactions. Every transaction happens through a bank. And of course, the third thing that there is, I think quarterly reporting. So we operate under a sandbox of the central bank. So we have to, share the data and all details and possible. But the most important part is the number one, that there's full KYC. You can actually track these people, who's financing, who's getting the money. And then the second thing, that these transactions are happening through formal banking channels and not anything offline. So yeah. The other thing I'd add, and that's sort of inbuilt in our model, is it is a closed loop system, right? So because iFarmer is not just a financing company, right? So we offer 4 core services to the farmers. Financing is just one part of it, because we also distribute agricultural inputs. So part of the financing, actually almost 30% of financing when it comes to crops goes to buy inputs, right? And that's where, because we have the input distribution business, so that instead of money, is the input that the farmer get. And then because we do off-taking, so once we buy back the product from the farmers, the loop closes and all the transactions are visible, right? So that model also helped the whole closed loop economy or ecosystem that we're trying to build.
Thank you for that, Fahad. I noticed from all your responses that there was a key that sandboxes played a kind of role in how you entered into the markets. Maybe starting with Parveen, you didn't specifically mention this, but in the markets that you've operated in, have you been asked to join a regulatory sandbox? If so, what was the experience versus those that you entered even with uncertain regulation? And what lessons did you pick up from that?
Thank you, Anthea. So from my experience, based on the product or the work that we were doing across fintech, we were not required to join the fintech sandbox held by the Central Bank of Malaysia. But what I've also observed, especially when we are also investing in other fintech companies, oftentimes like sandboxes are for a big ticket or like large organizations who have some sort of like a track record and they're building something, especially in Malaysia and other countries I've seen in Southeast Asia. So what I believe that, and I felt that, when the Joint Accelerators program is built with the partnership with this venture capital ecosystem, with the regulators and with the banks attending those, it allows small players and who are actually starting up to present their ideas to to the regulators. Because oftentimes when we're actually going to the sandbox, you need to there's lots of preliminary requirements that you need to fill. But when you join an accelerator, impact investment programs and things like this, the barrier to entry is lower. So this will also give opportunities to young entrepreneurs who are actually having very good ideas to actually present to the regulators. And regulators are also aware about what's coming in. And they can, because I believe that as much as, as an innovators and a fintech specialist, we think about wear the shoe of the regulator. Sometimes I also believe that it would be really beneficial for the regulators to wear the shoe of innovators, like where they are coming from, because sometimes, the creativity, the curiosity of trying to help in a new way, especially when I look at the Gen Z, the youth, they're having a different innovative way of coming out with a product, because they say, okay, you need to serve us. So this is what we believe that we want. And sometimes for regulators, it's like, okay, maybe this is another way of we can think, maybe it's not as risky as we assume it's going to be. Because oftentimes regulators, they're also thinking, okay, there is no benchmark. What happened if there's something goes wrong? What happened if did not detect any risky mistake earlier? So I believe that those kind of partnerships is also beneficial.
Thank you. Maybe while I have you, there's a question specifically for you. Excuse me. So can you explain again how you work to be compliant with this Islamic finance regulation?
Okay, so in Malaysia, the concept that you're working on is the micro private equity. At the moment, there is no regulations governing micro private equity because of the ticket size and everything. But the most importantly for us to have any products that is Sharia aligned is the main things to have the governance body of Islamic scholars and who have the, especially most importantly is the governance, who can actually advise any product or any investment that we make, whether it's Sharia aligned or not. So that is our whole, what we have been working on board of advisors. So we have scholars. We also have some who have expertise in the Islamic finance to actually explain, to advise, okay, these are the, can you invest or can you not? Which are the product or which are the business that MSMEs are running that we can support on? So mainly for us, it comes to the governance. That means starting from having the board of governance who can explain and advise. And if there is any query, they can say, yes, it is Sharia aligned based on this reason. But mainly is the 5 things, no interest. Also, it shouldn't be under certain activities that is not allowed. And it should also promote inclusivity, honesty, and everything, yes.
Thank you, Parvin. I'm going to go back to Eric. You mentioned joining the CMA sandbox, and you had a few challenges here and there. But I'm now comparing that experience of joining the sandbox in Kenya versus, for instance, in Uganda, how that affected your entry or ease of collaboration with the different regulators. And if there are any key points you took away about that experience that can help either one, improve it, but even for others who are considering joining that, any key takeaways you got from that experience?
Thank you. So when we joined the sandbox testing program under the CMA, as I mentioned, there wasn't a regulation that clearly governed what we were doing. We were more or less operating with self-governing as the main way of operation. But once we joined the Capital Markets Authority, one of the benefits we gained was we were just able to have somebody who, at a regulator level, who was a sounding bell to whatever we were trying to do. We gave them our business model, what we operated, what we intended to do, how we intended to get to where we were going. And they looked at it, and we had conversations with them, and eventually were able to be exited successfully under the sandbox and then we started operating in the market. So that was a beneficial thing for us in Kenya. I think that then tells me that whenever innovation, for example, comes before the law, I think regulators, this would be a good way for them to actually bring in these particular innovators to the discussion table to just understand what new products are out there in the market, what is what the underserved market needs to be in order for them to be properly served. We know, for example, in the financial sector, banks will not go where we are going because of the asymmetry of information. So they don't really understand the customers that we are working with. So there's really importance in terms of being able to understand and regulators being able to support the people who are going into this space. So a lot of the times we're introducing new products that might not really fall within any regulatory framework. And I think it's good for all regulators to have a listening ear to see how they can be able to work with us to be able to launch those products in the market in a safe manner. Because I agree, the primary obligation of the regulators is to protect the general public so that you're not introducing harmful products. But they also need to be a bit more open to new innovations and understand that sometimes the law may not be able to quickly catch up, so they need to find a way to bridge the gap between the law and the innovation. So in Uganda, we've not been able to, we've not actually not worked under a sandbox testing program. We just launched in the market. We got a license as a tier 4 lender in the market, and that's how we've been operating. But it's always, we are always on the lookout. We're always having conversations with a lot of the regulators that we work with in order to test out new products to be able to properly launch those markets. Because for us, yes, we want to emphasize on the side of innovation, but you also want to understand that where the regulator is coming from as far as consumer protection and all that is concerned. So balancing that, I think a sandbox testing program would be good. In Kenya, the central bank has not yet issued a sandbox testing program to more or less test products in that market. The expectation is that if you're more or less playing within that market, you need to just find yourself within one of the regulatory bands that are currently there. So I think it's important for regulators to be open to that particular way of engaging with the players in the market.
Thank you so much for that, Eric. Fahad, if I can go back to you, you've also participated in the regulatory sandbox. As you mentioned in the beginning, there was not really much help, but how has that evolved over time? iFarmer has been in existence now for 6-7 years. You've grown. You have a lot more farmers in a lot more industries, not just financial sector per se. You're also working directly with farmers. What has that meant for your regulatory requirements? Has that been beneficial over time? What does it look like at the moment in terms of the compliance that you have to adhere to?
I think at least the good thing is that we had a sandbox. But I think the downside of that is I think this was probably the first regulatory sandbox in Bangladesh. So I think the regulators were also not very clear. Like, okay, fine, we've created a sandbox, but now what do we do, right? So I think that challenge was always there. But over time, I think this has improved. One of the biggest challenge, at least in the Bangladesh, the financial industry, is fintech is not yet everyone talks about it, but we still don't have a proper office, people within the central bank to look at fintech. We have a department which is, of course, a very different department designed to do other stuff. But of course, fintech is now put under their jurisdiction. They have a lot of things to manage, and then fintech sort of falls low in the priority. But I think they've been trying, and then the sandbox is also operated by that team, right? So it's just that one team which is having, they are having to look at multiple things. But I think the sandbox, what I think has been very beneficial, at least it gave us a space for conversation, right? It gave us that platform where we can go and talk about our business model, how we are trying to fit in, but we're not able to fit in, and all the challenges, right? Even when the central bank said, okay, what if we give you, one of these existing licenses? And then we're like, but we can't adapt to this, suddenly just because you're offering us an existing license. And those conversations, I think, really helped for us as founders to understand how this works, because when we started, I honestly think we were very naive, right? As a founder, we thought, okay, we'll change this, we'll do this, but at the same time, we had absolutely no clue how regulators think about such new business models and stuff. So the sandbox also helped us to learn how to navigate the regulator as well, right? So I think sandbox. I mean, of course, we expected a lot more from the sandbox, but as I said, the regulators were also trying to figure out how to operate these sandbox. Is it like an accelerator program? Is it like I don't know, some kind of an incubation, platform? But while that was happening, I think we were having those conversations, which before the sandbox, we just did not have a place or a space to have these conversations. So I think that was the biggest takeaway for us, at least, to have that space for conversation where we also learned, but also I think the regulators became much more aware of these new business models that are now emerging. It's not just us, there are other companies in the sandbox. So I think that conversations also help the regulators to shape how they think about these new businesses.
And this has been such an amazing conversation. And just thank you so much for that. I've learned quite a bit. And what you've all done is bring out this nuanced issue of you're bringing an amazing new product into the market. It has the potential to increase financial access, to improve social and economic challenges facing the community. But at the same time, it's a risk for regulators and potentially the community. So how to balance that? You want to bring something of value, but at the same time operate in a system that is safe and protects the financial integrity of the system. And just about that balance, we have some useful tools such as the regulatory sandbox, but there's still ways in which we can improve its efficiency and effectiveness. And so I just want to thank you so much for taking the time to share with us. We've run out of time, but I think this has been a very useful discussion.
So let's get started with the first presentation from our first two lead discussants from Group 1, which is on AI-enabled financial services, Ms. Maria Masila and Mr. Marcel Beer. The floor is yours.
Thank you very much, Vida. We definitely did had interesting conversation, even though we were expecting the number to be slightly more in our breakout session. I would let Marcel just round up everything briefly. So, Marcel, I'll give you the floor.
Thank you, Vijay. Thank you, Mariama. I'll raise the points I've taken note of, and if I forget something, please compliment me. We began with a short discussion on how AI tools are being used by central banks of the participants in our group. We've heard from Huram that the State Bank of Pakistan is using AI for economic forecasting and is considering using it in the licensing process, which is lengthy. I can attest that it's also lengthy in Brazil, and AI could help in this process. Ali, also from the State Bank of Pakistan, differentiated the AI in the central banking community in two aspects. One is the use of AI in central banks, and the other is the use it by the market. We discussed how to deal with AI, if we should have a hands-off approach, or if we could have strict regulations or even balancing between them. We've heard that the State Bank of Pakistan is using non-binding guidelines, but supervisors go in place in the institutions and make sure that the guidelines are followed. So I would say it's a balance between the hands-off approach and a more compliant one. It's a topic we also want to raise, is that the lack of capacity by central banks to supervise and to regulate such a fast developing technology, which is AI, is an issue. It is an issue, and central banks have to be agile and keep up with it. Data quality was also mentioned as very important to avoid the exclusion of users, of fragile users, be it gender-based or geographical-based. So having good data quality ensures that models are trained with balance and with equality. And finally, we discussed frontier models, those that are raising hairs in the central banking community, creating anxiety on cybersecurity. It's a topic that it is and it will raise a lot of discussion as we see it developing every day. We have news on it. And finally, it was mentioned that this cybersecurity topic is strictly connected to geopolitical issues that have raised recently, and they increase even more the stakes and the risks related to AI. This is what I could. It was not much of a summary, but this is what was discussed in our group. If Mariama wants to add something.
Thank you, Marcel. You've nicely put together pretty much much of our discussions, and we also touched on vendor concentration, which is a problem for all members, basically, as we have the same vendors supplying. We also talked about how, for example, the Central Bank of Gambia, that we have a dedicated department in some of our institutions, such as the fintech, to regulate these. But I think overall, Marcel has summed it up nicely. That was what our discussions centered around. Thank you.
Wonderful. Okay. Thank you so much for that sharing. If there's nothing else to add, perhaps we can move on to the next group, Group 2, which is on consumer protection and cryptocurrencies and digital assets. And our two speakers are Leah from Emphasis and Roberto from the Central Bank of El Salvador. Over to you.
Thanks, Vidya. Well, I'll just give a really brief overview of what we spoke about, and then I'll hand over to Roberto, who will share with us some of the key takeaways. But I thought one of the things that struck me right at the beginning of our conversation, I was just asking Roberto about El Salvador's approach to adopting Bitcoin as legal tender, but also the development of the Bitcoin law and supporting regulations and policies that have come after it. But one of the things he said was that they quickly realized you can't approach this with a traditional mindset when we're thinking about crypto assets. You can't just fit everything into a neat little box. And it actually reminded me of an opinion piece that I read all the way back in 2017 about how Bitcoin was a category creator as opposed to one that was a follower. So I want to share that with you in the chat. It's called Bitcoin is a Platypus. Please enjoy. I'll leave that with you guys to read in your own time, but it's very much about how you can't just fit these crypto assets into any existing label or framework. We really need a completely new approach. So Roberto elaborated to share their tech native framework in El Salvador with 3 critical guardrails So firstly, you can't just launch a token with a white paper, some flashy white paper, and just raise money on the internet. You need to be able to provide something that is sharing what is being offered in very plain language, the risks laid out. Obviously, please, this is a brief overview, and Roberto can explain it better, but please take this as a very brief overview from me. But secondly, something that was really important was the registration of crypto asset custody services. So having some kind of recourse when things go wrong really helps with trust. Roberto was explaining, this is especially important when people are quite afraid of using this tech. Trust is a really, really big thing there. And if people don't actually have someone to help them when things go wrong, that can be a huge obstacle to adoption. And thirdly, it was around operational resilience and traceability, even centralized supervision around AML. So in crypto, this technology is inherently immutable. There are no chargebacks. So, for example, when something goes wrong with traditional finance, you might actually rely on being able to reverse that transaction, but it's not possible in crypto. So we actually need to focus or refocus on the front of the transaction before it happens in terms of consumer protections, rather than reversing it after something has gone wrong. So those were the three critical guardrails that we glossed over. But the key thing that Roberto was sharing was that it was not about restricting technology. It's about embedding accountability. I really loved that soundbite, and I thought it was something that we could all take away from it. But then there was a twist in the plot. We learned that, there was a point where, with all of these new guardrails, new understanding of the technology, increased adoption, regulators, policymakers might have been starting to get a little bit more comfortable thinking, okay, we've got control of this space. But then bam, AI comes in and suddenly everything is out of control again. So we realized that particularly things like social engineering scams have just, as I'm sure many people here have probably experienced, really amplified and become far more sophisticated and tailored in terms of their targeting. So that is a new threat which absolutely integrates in the crypto space. So I think we'd need another entire conference to unpack that in its entirety. But we were very lucky to have Raman Pervez from State Bank of Pakistan. He jumped onto the stage to share his point of view. And I think what was most interesting to me was that he was pointing out that in Pakistan, they have gone from prohibiting commercial banks from using digital assets or being able to use this technology widely, right through to exploring so many different avenues, everything from bringing on Binance to actually be a licensed provider under their new regime, looking at conversations with the likes of Circle, which is a global stablecoin issuer, even looking at wholesale CBDC, and how some of these new partners could actually help them solve some of the biggest problems in Pakistan, particularly things like the high cost and slow pace of remittances. The catalyst to this, in terms of the big change, was really the identification of the prevalence of scams and the need to take consumer protection in crypto and digital assets more seriously. So I thought that was a very interesting takeaway for everybody here. But Roberto, I would love to hand over to you, I guess particularly for a nation that has absolutely embraced crypto and digital assets. What were your takeaways from this session?
Thank you, Leah. I think you summed it up very good, very perfectly. But okay, so I'm going to say a couple of things that I take from this session. First, okay, so we talked about minimum requirements that we should have as a regulatory framework for digital assets. And what we mentioned is that there should be some traceability and accountability for something when something happens and when there's complaints. And the base of this is regulatory registration for digital asset service providers, because when we have these service providers, they must legally demonstrate that they have, for example, segregation of customer assets and maintain explicit accessible redress mechanism for user complaints. So this allows people to be more trustful and to be able to use the digital assets. So I think one of the main insights is that there should be minimum requirements, and this will help to solve one of the other things that we talked about, is that we have the strong rights problem, that some legislations have different regulatory requirements that are more strict than the ones that other countries use. So we have to level up this regulatory requirements so that we can cooperate and we can have a better safeguard for consumers cross-bordering or having, for example, scams that go from one country to another. And lastly, I think we talked about remittances, and one of the big things that we talked about is that we are still working in using digital assets and remittances in our countries, in legislations like El Salvador. We still use money. We still use cash. So there's a big work there that we should start having more education to people, that they understand what the use of technology could benefit them, as in reducing costs. But we have a long way to go, so we're still starting to get our first steps into this new era of technology. So that would be it in our part. Thank you so much. Thank you, Leah.
Thank you, Roberto. It's been so fun co-hosting with you.
Same
Awesome.
to you.
Thank you. Thanks so much, Leah and Roberto. That was an excellent summary of your discussion. It was very, very insightful. Thank you so much. Okay, and to our last and final presentation for today, we have Joanna from UNHCR and Ricardo from IFC UNHCR Joint Initiative. Over to you.
Thank you, Vidya. Unfortunately, Ricardo had to leave for another an urgent commitment, so I will do my best to summarize what we've talked about. So we started by setting the stage and setting the scale of displacement, how important it is in this moment. There are fresh figures from the UNHCR Global Report 2025 that estimating almost 118 million forcibly displaced persons around the world. These forcibly displaced persons are include different groups of peoples. We are talking about refugees, almost 42 million, talking about asylum seekers, all close to 9 million, but also internally displaced people that reach around 68 million people. And the distinction between these groups are on the question of refugees and asylum seekers moved to different countries, while internal displaced people were forced to flee, but they remained within their countries. And so these will have different conditions and different financial needs and different conditions to access financial services in the countries and the places where they moved to. The financial needs are also different according to the stage of displacement and to the socio-economic profiles of refugees and forcibly displaced persons. So a first main message we wanted to bring is that we are not talking about one segment of forcibly displaced persons. We are talking about different groups of populations with different needs and different capabilities to access financial services. And for them, financial inclusion is an essential tool to rebuild their lives, to achieve self-reliance, to be able to contribute to their host communities. So promoting effective access and usage of financial services is important, and fintech and digital solutions are crucial and can be a critical enabler of this process. So we started looking at the barriers that FTPs face and discussed, among other things, that these are actually contextual and they vary across locations depending on one the legal status and immigration or migration status that FTPs have, also the rights that they have in these countries. So having the right to work, the right to own a business, freedom of movement, access to official documentation is crucial for their economic and financial inclusion. And looking at the barriers, we see that these are compounding barriers. So we have barriers from the regulatory and the infrastructure side. And here, know your customer documentation requirements and the process for verifying these documents are crucial. FTPs need to have access to identity cards, identity documents that are recognized by the financial service providers, and this depends a lot on the regulatory framework. Infrastructure and the mobile connectivity, access, the administrative capacity to issue documentation, and the interface between the financial service providers and the national identity registry are also critical factors. And on these questions, we had our colleague for Eswatini talking to us about how despite not having a large population of FTPs in the country, these questions about the legal status and the asylum laws are really important and can really be a barrier to accessing financial services. We talked also about barriers on the supply side and the questions related to the unfamiliarity of the fintech and other financial service providers with this segment. And so our data is important to these institutions to understand these populations and to potentially look at them as a potential client segment that has levels of risk that are manageable by the institutions. And here we talked about solutions like tiered KYC frameworks, and our colleague from Egypt was mentioning how Egypt is implementing this type of approach, although for now not focusing specifically on the FTP populations, but on different kinds of vulnerable populations, including women and smallholder farmers. We looked also at demand-side barriers, and here the questions related to the distrust on the financial system, the lack of financial and digital literacy, and questions like language barriers and social and cultural norms. We had a colleague from an NGO working with disabled persons, bringing up the question about the accessibility to the digital solutions and accessibility in terms of the having access to devices, but also how the different solutions work, and how this should be kind of a priority or something that should be subjacent to any regulatory framework or any regulatory initiative that promotes digital literacy and that promotes the digitalization of processes on the financial system. On a second part of the discussion, we looked a bit more in terms of what are fintech solutions and prerequisites that are important for the fintech companies, for the FSPs to actually decide to look at these segments and decide to serve refugees. And here, clearly, having the development of digital identity and KYC verification systems is important and is something that can smooth onboarding of the FTPs when they access the services. Also, the tiered KYC frameworks are important to deal with the levels of risk and understand how these populations can access these services. And two last points on the interoperability of the payments and financial systems and the coordination among regulatory and other government authorities to make this interoperability possible and for FSPs and fintech to be able to clearly access the information they need to verify the identities and be able to comply with KYC requirements. And last point on the use of data for credit scoring and for other processes by the fintech. And here, the role that organizations like UNHCR, like WFP, that have large databases on the refugees, on the FTPs and their characteristics, how this can be very useful to de-risk the operations of FSPs and fintech that are entering the market. And I think I'll stop here. These were the main points.
Wonderful. Thank you so much, Joanna. That was really, really insightful and interesting indeed. Thank you so much for that. Okay, now we can move on to our final segment for the day, which is our closing remarks by none other than Robin Unum, who's the Head of Policy Analysis and Guidance here from AFI. Please welcome Robin to the stage. Thank you.
Thank you, Vidya. Well, what a fascinating set of discussions and insights we've had over the last couple of hours. I think that has more than fulfilled our expectations for this event. So thank you all so much for the role you've taken today and for your candid sharing. We've had actually member institutions participate from almost every region of the AFI network, alongside alumni of our Fintech Showcase program and partner organizations of AFI. So events of today, they're really helping us to fulfill the original mission of the Fintech Showcase, which is to connect policymakers with innovators to overcome practical challenges and to co-create impactful solutions. Just a recap of some of the key messages that we have heard today. Of course, AFI CEO Dr. Alfred Hanig opened the event by describing the shift we're already seeing in our collective agenda from financial access, where we've seen a lot of progress, but now starting to look towards other dimensions, usage, quality, and ultimately financial health. I think the rest of the discussions today have been a real sort of litmus test of where we stand in achieving those ambitions in practice. We then had an excellent keynote from Professor Olayinka David West, setting the scene by asking, who is fintech actually serving? And Professor David West reminded us that there is often convergence in ambition, but divergence in practice between the regulators and the innovators. And we really need to look at that area to fulfill the goals that we have for financial inclusion and make sure no one is left behind. We then heard from our very first winner of the FinTech Showcase, Simon Schwal of OCO, giving us the view from the field, showing us that patient innovation built in partnership with regulators can really reach customers that the formal system has never touched to this point. We had a fascinating panel discussion as well, featuring Eric Kariuki of Possessia, Fahad Ifaz of iPharma, and Pavinjit Kaur of Bino, or alumni of the FinTech Showcase program. They spoke very candidly with my colleague Anthea Paolo about where collaboration between innovators and regulators is working in practice and where frictions remain. And I think there's a lot of practical insights to come from their case studies, how they've achieved implementation at scale, and how they've sought to build those partnerships with regulators along the way. Then in the second part of the program, we've had those interactive breakout sessions that you've just been hearing about. I was in the crypto session, which was fascinating, I must say, but it sounds like the sessions on AI and FDPs were equally insightful as well. So there's a lot of important takeaways that we have captured from those discussions. And rest assured that we will be working on advancing those, on making sure that those insights are incorporated into AFI programming, into the work of our technical working groups as well. There'll be more to come on these topics, of course, in the form of AFI knowledge products, other peer learning activities, also the in-country support that we provide to our members. So don't think of this as a one-off event. We hope to continue a close relationship with all of you and invite you back for many other occasions, as well as we make practical strides forward in addressing the shared challenges we've talked about today. So just finally, a few words of thanks for making today's program successful, to the presenters, to the panelists, moderators, or the lead discussants. You were so generous with your time, sometimes at quite short notice, I must say, and also the great insights that you have shared today. Thanks to our showcase alumni, of course, those that have rejoined us, which is really showing that the program has been successful to build a community between regulators and innovators. And thanks to all the participants who joined, who contributed, or even just, listened in, and hopefully you'll have some takeaways that you can apply in your own jurisdictions. Finally, just to go back to one of the messages in Dr. Hanig's opening remarks, he talked about the importance of the financial regulator, the central bank of the future, being defined by adaptability and building new genuine partnerships with innovators. And I think today's event has been an important step forward, showing us that this actually isn't just the regulator of the future, it's already coming into practice across the AFI network, which is great to see. So thank you all so much. We look forward to continuing the conversation with you and also the practical in-country work to make it all a reality as well. Thank you so much, and I'll pass back to our MC Vidya to close out today's event.
Thank you so much, Robin, for summarizing that so eloquently. That was a great set of closing remarks. So thank you for that. And last but not least, if we could please ask everyone in the room to just scan the QR code you see on the screen. And also, I've just sent the link on the chat. If we could just take a couple of minutes just to give us your very honest feedback on this event, we would love to hear from you. So I'll just keep this up on the screen for a couple of minutes. And thank you all so much again for joining us today. We really enjoyed having you. And have a great rest of the week.